nine, eight, seven, six, five, four, three, two, one.
Good morning or afternoon to everybody that's joining. My name is Jonathan Boyarsky, and I'm a venture fellow here at Newchip Accelerator, which is an online accelerator that helps startups get going and puts them in front of investors. Today we've got a panel on fintech investing, and we are joined by four really interesting and impressive guests. I'm going to allow them to introduce themselves a little bit, but we're going to go ahead and introduce them a little bit, and then they'll kind of explain, who they are and what they're doing here. First, we have Rich Cordray, who was the former Attorney General in Ohio and the first director of the Consumer Financial Protection Bureau. He is also the author of Watchdog, which is a book about protecting our consumers and how that can save our families, our economy, and our democracy. Thanks for joining us, Rich. Tell us a little bit about yourself.
Okay, thanks, Jonathan. My background is, as Jonathan described, mostly as head of the CFPB. I came in contact with the fintech industry across the country. They were and are looking for ways to innovate in the financial services space. There's a lot of room for improvement there. And we had a lot of interaction with fintech companies who were faced with uncertainty about the regulatory regime and looking to grow and help us understand what was happening in their markets, which provided us a lot of great insight, and we looked to clarify situations for them in lots of instances as well. We have a project Catalyst at the Bureau that was focused very specifically on fostering financial innovation in consumer financial services.
Awesome. Thanks for joining us. We're really happy to have you on and think that your perspective will be much needed. Next, we're going to go to Haafiz Abdurrahim, who has the founder and CEO of Riftpay, which is a social banking platform that allows users to share, save, and spend money together. Instead of paying for your friends, hoping they Cash App or Venmo you back, you can pay together from the start. So Haafiz, thanks for joining us. Tell us a little bit about what you're working on.
Yeah, thank you, Jonathan, for having me. So like Jonathan said, we're working on a social banking platform. You look at the financial industry right now, especially with fintech, everyone focuses on the individual. Our stance is taking groups from the beginning and focusing on them and making them our main bread and butter, basically. So best example I can come up with is college roommates. They're splitting bills each month. They're paying together. Usually one person covers that whole cost, and then hopefully they get paid back by their friends. Sometimes that doesn't happen and puts that one person at a financial deficit. So we want to be able to provide a platform where users can spend and save money together and then spend together.
Yeah, I think there's a lot of space there. Thanks for joining, and we're glad to have you. Next is Jacob Singer of Kredit, which is empowering consumers to strengthen their credit profiles and access funding through our unified platform that blends credit building with personalized lending. Jacob, tell us a little bit about what you're working on there at Kredit.
Yeah, so we're working on helping all the millions and over 100 million Americans who are disproportionately impacted by the way the credit system is set up, and impacting their access to capital, which is critical for financial freedom. So our mission is to help them level the playing field and help them to rehabilitate their credit, to rebrand their credit, build it, and maintain a healthy credit profile, all in one unified platform, which parts of the services exist, but a bunch of them are novel as well, and the first of its kind, and definitely, a one-stop shop that consumer doesn't have to research and sign up for 15 different products and not know when to utilize them.
Yeah, and with so many loans dependent on that credit score, I think that your product is much needed because it really just allows people to spend less money on interest and get better, kind of deals for those loans, which people do need. So thanks for joining us, Jacob. We appreciate it. And lastly, we have Mike Chu, who is the founder and CEO of Recap, which is a tech-driven asset manager that helps socially conscious investors access sustainable investing strategies with highly personalized portfolios. Mike, thanks for joining us. Tell us about what you're working on.
Hi, Jonathan. Thank you for having me. Happy to be here. So again, Mike Chu, founder of Recap. We help socially conscious investors access sustainable investing with personalized portfolios. And broadly speaking, the proposition of sustainable investing and what it means for retail investors is very simple. It's that you can achieve your financial goals by investing in companies that are managing their environmental and social footprint well, and even contributing to solutions in those areas. To kind of break this down and how it works and how we think about it, first and foremost, you have to kind of believe that environmental and social costs are real and that companies should be accounting for that in their management. We then take a look at how the market is collectively pricing in many of these issues, or what we consider to be material in the quantitative model that we've developed in-house. And then lastly, we let the investor choose which areas of impact are important for them. And then we build an individualized portfolio that directly held stocks and ETFs with the goal of tracking market returns. And then we help them manage our strategy going forward. So our first product is a robo-advisor that lets individuals get up and running with a very functional portfolio in a very easy to use manner with just 3 simple questions that they have to answer. And in fact, in the upcoming launch, we've also combed through all the reports and metrics for our top 30 companies to build stories impact stories that we call it, that makes it very easy to understand. So we find that in folks that we've talked to who are interested in this space, that understanding the why and how is really one of the major challenges. And we're really trying to bridge the gap for investors who want to engage in this style of investing.
Well, thanks for thank you for all of you joining us. Let's dive into the first topic, which is sorting out the players in fintech. With a lot of financial innovation, it kind of rests on the consumer. And the consumer is often sort of overflooded and inundated with different decisions to make. And I think that we really run the gamut here with all of your startups, because we've got consumers who need help building credit. We've got consumers who are doing peer-to-peer kind of payback and lending. And then we also have kind of those who are investing. I want to start with you, Rich, though. Talk a little bit about how consumers make decisions when there's just so much to choose from, and how consumers really think about financial health for themselves and for those around them.
Well, I think the reality is that often consumers don't make those decisions particularly well. The financial services field can be complex. Sometimes it's fairly straightforward, and there's lots of ways that consumer financial products serve the public and serve their customers. And if they didn't serve them at all, they would probably go out of business. Nonetheless, consumers face a confusing array of different terms and conditions. The nature of financial products is that they are special in the sense that they really just consist of different arrangements around money and contractual terms. I think that the complexity of financial products is a meaningful problem in this space. It's one we tried to address at the Consumer Bureau by simplifying and improving disclosures, and that takes you so far. Financial education takes you so far. But there's still lots of need to make sure these products don't take advantage of people, that companies aren't taking advantage of some of the behavioral shortcomings that people have, and just lack of know-how.
That's a good point. It leaves many consumers distrusting of financial institutions and banks in general. And now they don't want to go to a payday loan, and they don't want to take out money from a bank or take on an extra credit card. And they get, I think, very nervous and just hesitant about really signing on to things. And Jacob, you're kind of addressing this. So do you want to talk about sort of how people get left in the dust by these banks and financial institutions that really take advantage of people, and then how their credit score rating, just kind of drops? So how have you found sort of getting consumers on board and kind of, interacting with that community? What have you noticed?
Thanks for the question, but we definitely have a lot of customers. We've had 10,000 come through our doors already. That a lot of data with them, not being aware of terms certainly, but I think more so we have an issue where they can't build and access capital. So that's why they get stuck in maybe onerous terms, cash advance, or things of the sort. And there's all these great new startups that are coming up with new ways of lending and using alternative data to make decisions. But it's more like especially new people who are new to the credit market, which experience says is the biggest segment, and those people really need access to capital. That's the time that they should be accessing capital. Just have a thin file. They don't know how to build a credit, and they're just turned away from lending. And it gets a little cyclical. And so just one more minute, it gets a little cyclical because they're not able to access traditional capital. Either they go to really high interest alternatives, which puts them in a bad place, or they'll go to like family and friends, which is always an uncomfortable situation. But when they borrow from their family and friends and they pay back on time or even not, there's no record of that. That's not really part of their credit profile to then build them credit down the road to be able to go back to traditional lenders and access capital that way.
Yeah, and I think that's a good point. And then when banks don't have a history of your credit or you have bad credit, then they charge you a higher interest rate or see you as a higher risk loan and try to recoup their money faster. And then it sort of, like you're saying, results in this cyclical process wherein people just eventually run out of ways to access capital when they desperately need it. I think most Americans in this country don't have $1,000 in savings. And so whenever there is a situation that arises where they need that, it can be very difficult for them to sort of get by and to figure it out. But, products like yours are kind of helping them put their credit back on track and really focus their, financial spending habits and really kind of just hones in, make sure they're doing what they need to be in a financially healthy place. And I kind of want to dive into something next, which is it's not like, other products out there. Like when you compare a car to a car, it's really obvious. You say, this is what I get. This is the report. This is how often it breaks down. And it's a much different decision, but with financial products, it becomes much more complicated. Mike, you want to talk a little bit about how, when comparing options to where I should put my money, why and how somebody might want to kind of look at recap and say, that's something that I would want to put my money to instead of just going to like a classic, just investment option or investment advisor.
Yeah, sure. Thanks, John. So I think part of the challenge for a lot of new investors is just understanding the options that are out there for you and then making the right choices accordingly. And so really that comes down to a couple of major factors, I would say. So, when you think about investing, one of the big ones is how involved do you actually personally want to get in the process, right? Are you looking to actually manage the money yourself, do the analysis, build the portfolios yourself, or are you looking to delegate that to a professional, whether it be an individual or firm, to do that as an advisor? And then I think that's one of the first major decisions. And then when it comes to the delegating portion, how much do you actually value that that relationship that the advisor is providing? And then versus of course, if they're giving you that personalized attention, there's going to be a cost associated with it. So it's going to be the more expensive option. So where do you draw the line between how much you value that engagement versus actually paying more for a automated self-serve type of an option? And then specifically for sustainable investing, I think that we have additional challenges, which has to do really with a very new emerging, I would say, set of analytic toolkit and standards that's really come out very recently. I think the industry as a whole has been thinking and kind of inching towards doing more in this space for a number of years, but it hasn't been until the last 3 or 4 years where the analysis toolkit is starting to be a bit more standardized. But even so, it's very daunting for new investors who try to do this themselves. And so when you try to marry together building the portfolios, doing the analysis of companies, putting everything together, and then having to manage the money on an ongoing basis, that's where that's really what we Recap try to make it really easy. We do all that really in a very we get into the minds of consumers and what they intend to do with their money, and then basically do all the analysis and bring together institutional grade frameworks to put those portfolios together. And then we also manage the money on an ongoing basis at more reasonable costs than the traditional advisors have been charging, which is part of another macro trend, I would say, of just things getting more friendly and cheaper for consumers as a whole.
Yeah, for sure. And I think that your space is especially interesting because when we talk about people who want to invest in sustainable and ethical companies, I think we're starting to see this trend. And I think and hope that this will drive better behavior from large players, both in the financial industry and the non-financial industries, to kind of be better about their practices in terms of how they approach dealing with customers and really everybody, because I think as a society, we want to move towards people really only buying from institutions and companies that they trust and know to be good players in the marketplace. Haafiz, I kind of want to go to you now and just sort of talk about how also, when it comes to consumer finance, it is often a community thing. We know people lend to their neighbors. My dad will sometimes lend interest-free to his employees, and these are kind of ways that we can help out. So you kind of want to talk about, how your app is kind of helping that and sort of the trends you've noticed and seeing, how people interact with each other and how they can really help each other.
I think the biggest thing we've seen so far is people are scared to talk about their money and even more scared to share it. But when you make it a social type of app and make it an environment where they feel comfortable sharing money with each other, there's security protocols involved where they're guaranteed they're not going to lose their money. That's when they feel more comfortable actually putting in money with their friends, spending together, and taking that burden off the one person that's supposed to cover the whole cost.
Yeah, I think that's a good point. I also think that, apps like that and the GoFundMes of the world really are enabling sort of financial empowerment to those who really haven't had it in the past. The world has become more globalized and fragmented in some ways, but also better connected in some ways in a virtual sense. We've really seen people come together and help out those financially when they need it.
Exactly. Just kind of bouncing off that, the social factor, right? Like my generation, Gen Z, the social factor is insane. You got Twitter, Facebook, Instagram. It's all blown up in the past couple of years, and things are moving towards a more social atmosphere than it was like protected, your individual, your own family. And I think that's the perfect time for us to come in, offer this service for consumers for free, and say, hey, just spend your money together and take away the hassle of everything.
Yeah, for sure. I want to dive into next one of the go ahead, Jacob.
All right, just to build on what Haafiz said, and that's something that we've noticed a lot also, that consumers are realizing more that, them having bad credit or minimal credit is not a source of shame or embarrassment. And it really demonstrates when, we help them with the service, or they're talking about it in Facebook groups, they're posting it, things that, a generation ago, nobody would ever discuss, let alone post publicly. Like, they view it as like, they're fighting the system and they're growing, and it's, they're leveling the playing field.
Yeah,
exactly.
Hashtag debt free, like the big thing trending on Twitter, talking about your student loan debt.
Going off that, Rich, I want to go to you. How do you sort of see the private sector balancing, and working with the public sector and government regulation to really kind of help these ballooning debt problems, whether it's student debt, auto debt, and just the financial struggles that people are kind of working with right now?
I think often the private sector and the public sector don't work all that well together. In an area like consumer finance, which is heavily regulated, often the companies are a bit gun-shy about having too much interaction with their so-called regulators because they just don't want to be on the radar screen. And we found that was particularly true of fintech companies who are starting up. They're unfamiliar often with the regulatory regime. They view it as hostile and threatening, and they aren't used to knowing how to comply with it. We found that was particularly fertile ground for us. We had an office hours program where we spent time talking back and forth to each other. We reached out to them. Sometimes they would reach out to us, and often they would accept our invitations to spend time and talk. It helped us understand what was going on in the financial industry much better, but at the same time, I think gave them a more realistic sense of what some of the expectations were. But I think that many players in this area, they're not comfortable with government. They see it as potentially constraining what they do. The adage in technology industries of move fast and break things, especially as a startup, isn't all that compatible with a significant regulatory regime like you have for financial services. So I think there's room for more understanding and more cooperation, but I think that it often doesn't exist where it might.
Yeah, and I think that's sort of unfortunate because I feel like a lot of fintech startups, especially on the smaller side, I mean, larger, I think banks and financial institutions are kind of at odds with government because what they've been doing for so long has been working for them, and they don't want that to be mixed up. And I think initially there is some incentive alignments with consumers and banks, but I think those incentives quickly become misaligned once banks aren't making their money back. And if anything goes wrong, then I think the incentives between consumers and banks and large financial institutions really just go down separate ways. But I think that also gives rise to new companies like what Jacob's working on, what Mike's working on, what Haafiz are working on, which is people don't always want to use these large, banks and financial advisors. And I think that we're now live in a world where financial tech is accessible to everybody on their phone. I can get Robinhood, I can get Venmo, I can get, Riftpay, I can get any of these things right on my phone. And so I think it will be interesting to see whether or not there is a mass exodus from these large banks and other financial institutions towards other methods of managing your money. But it's something that I think is certainly uncertain at this point, whether or not that will really happen. Also, banks have tremendous power in this country. So working out how to interact between those and government, I think is also very complicated. I want to now kind of go to fintech as a force for good. I think a lot of small, privately held companies that are growing, like the startups that you guys are working on, often are designed to help consumers when they're struggling or with whatever they're working on, whether it's investment, payback efficiency, whatever it may be. So how do you guys sort of see your companies really helping people out, and why is this something that is sort of needed in the industry?
So I can definitely start out, and touching on what we just talked about with banks, I think it's a three-step process, right? Three-way relationship where you have the fintech who's in relationship with the bank, and then the bank is in relationship with the regulators, making sure everything is going well and in compliance. And as a fintech, what I've learned a lot running the company is regulation is your friend. You don't want it to be on the back burner and then hope you can deal with it later. You want to deal with it up front and get it out of the way. And I think really for consumers, big banks, they haven't been the friendliest to consumers. They're in the business of making money, and that's what they're in the business of. I think the fintech's job, and especially with Riftpay, like empowering groups of people who haven't had that option before to spend money together, save money together, split money together in real time will really help our niche market.
Yeah, I think that's a good point. Anybody else?
Sure. Yeah, I would like to piggyback off of the point around the regulation. I do think that the startups, we have some baggage in the startup industry with respect to regulations and some of the stories that really are top of mind for people. Like oftentimes you think about Uber and then how they were able to expand by kind of bypassing regulation schemes. I think in the US, particularly with fintech, we have some stories historically like that as well. But I do think that there is like kind of an emerging group of like more socially minded entrepreneurs and startups that are coming out. Because I definitely think that it's been actually really good to be proactive in managing the regulations regimes. For us at Recap, we just finished our SEC registration officially as an RIA, and that process has been fairly smooth, I would say. I think the firms, the regulatory authorities have been very supportive, even with some of the changes in the new filings. And I mean, at the end of the day, like when you're a consumer kind of app, consumers have a lot of choice nowadays, and they can change what they do very easily. And so it really is in your best interest to really look out for them proactively and to make sure that you're kind of aligned with what the spirit of the regulation is trying to do in terms of protecting their interests. So for us specifically at Recap, we are more in the access side of helping consumers being able to access companies who are the good players there and provide that incentive. Like at the end of the day, it comes down to kind of collective action with other investors in mobilizing companies to take action and shareholder engagement. So.
Yeah, I think that's a good point. I think it does speak towards people's perspective as socially conscious consumers and socially conscious investors for sure. Jacob, your thoughts?
Yeah, I have a lot of thoughts, but I'll try to trim it down to one. I think we're talking a lot about them banks. If things go sour, they're not looking out for the consumer, or they're charging a higher interest rate. A big part of it is they are locking out, tens and tens of millions of people from accessing capital, which truly impacts their ability to, achieve financial freedom. But a lot of the new fintech companies are really working on much more, instead of historical, much more predictive analysis of a consumer's ability to repay, and actually credit being predictive. And, we're trying to harness that, where we allow consumers to take it into their own hands and to build it as they want. But it's not even against the bank's interest. If they were to have more transparent and more understanding of the real risk, then the interest rate, everyone would save money. They would charge a lower interest rate, or maybe higher in some cases, but to be more accurately reflecting the true risk and not some random score from 50 years ago, and which includes factors that are just very silly.
People have sort of gathered around the credit score as being the end all be all, but Rich, you can speak to sort of government endorsement or lack of endorsement on that. But when we talk about regulation, we often mean regulation for large banks and large financial institutions. But it's interesting to see how those regulations can really sort of get in the way of small startups that are trying to, step in and maybe do something more efficiently, or do something for, slightly better margin so that it's a better cost to consumers. But they can sometimes be slowed down and hindered by regulations. So, Rich, how do you view the difference between a large bank who does need a lot of regulation and small startups that are trying to help people and use financial technology to empower people who might be stifled by those regulations, by similar regulations?
Well, everybody in every business, including the financial services industry, believes they're helping people, they're helping their customers. And by the way, if they don't serve their customers and don't provide value to their customers, they won't last. I don't know that there's a big differential in intent between startup and big banks were small companies at one time, most of them as well. What I would say about financial innovation is, all that we know about financial innovation is that it's something new. That doesn't mean it's necessarily good or bad for consumers. It can be consumer friendly, and many startups start out intending to be consumer friendly, but then they run into pressures of funding and investors and the like, and things can take a different direction. Some of the most innovative financial techniques we've seen were exotic mortgage products, which ended up leading to blowing up the economy in 2008. So there's a need for oversight at all levels.
I think that that's a brilliant point about how, not every player, just because they're small, is necessarily actually doing more good than a large bank. And I think that...
And by the way, can I illustrate that? When I was the attorney in Ohio, we went after lots of scammers and fraudsters who might have been defined in a different world as a small business.
Yeah.
And we're working to put them out of business. And it was the right thing to do, because their business model was to take advantage of people, and you can't allow that.
Yeah, I think that's a good point. I mean, a lot of cash advance and payday loan places are small businesses, as we say, and they take advantage of people too. So it's interesting looking at regulation in that way. I also think that on that point is the fact that the fintech industry is growing from, about 127 billion in 2018 to more than doubling in 4 years to estimates around like 300 billion. But I think that that's a really good point in thinking about regulation for sure. I kind of want to just go next to just sort of changing trends in the industry. I think we've started to see a lot of companies pop up, but what have you guys sort of noticed in terms of startups and financial innovation sort of across the board outside of what you guys are working on specifically?
Definitely, I'll start out. Neobanks. I mean, that's the buzzword, right? Like, everyone wants a new neobank. We're talking to an investor the other day, and he was saying, we've heard about 25 pitches for a neobank for the young generation, for millennials. And at a certain point, the market becomes too saturated to have all those neobanks in the same place. Right now, I was actually listening to a talk from David Galvan from MasterCard yesterday. There's 5,779 fintech startups in the US. At some point, that's going to have to consolidate. Not everyone can use all of those companies.
everybody gets an idea to some financial tech company, and then there will be 20 of them at least. And then I think it becomes a marketing problem of who can get the most users and where will the consolidation happen. For sure.
You see Chime, you see Dave. But I will say, like, when we're talking about doing good for the consumers, that is one thing they offer that big banks don't, is the zero fee model. Offering that to consumers and not having them pay fees on the money they want to store on their platform, I think that's very beneficial for them.
Yeah, I mean, just to build up. Oh, yeah, go ahead, Richard.
Another trend in the industry is that you do see a lot of startups, as they start to succeed, the ultimate path is not to continue to be a freestanding company, but to end up merging or being acquired by or a joint venture, which often amounts to about the same thing, by some. And if that's the goal and that's a plausible trajectory, that can lead to different dynamics and different psychology for startups. And certainly it's one way for the larger players to swallow a lot of their competition. It doesn't mean that the fintech hasn't succeeded in changing the market or modifying the market, because it may be that their innovations are taken up and spread more broadly, but they don't necessarily do it by remaining a freestanding company. Very few fintechs have become mega firms like PayPal. Most of them have taken a different path, and often merging with banks, ironically.
Yeah, and I think that that's a really good point, which is I think the VC mentality is kind of myopic, and it is a 5 to 10 year mentality at the maximum. So what inevitably ends up happening is these startups, whatever space they're in, end up sort of becoming the thing they sought to destroy in some sense, or at least becoming part of an institution that might take what they built and really bastardize it in a sense and just turn it into a money-making machine, which I think is, it is in part a sort of just result and just a collateral effect of VC firms and the way that private capital has entered the startup industry, which is a very much return on ROI focused investment. So I think that is a really good point in terms of what we're looking at for these fintech as a force for good, because there is always the problem of, oh, we just sold to Bank of America or Citi, and now they're just going to either dissolve it and take our customers or spin it off into something that can get people to use our bank more. So I think that is a sort of good point. Mike, your thoughts on sort of changing trends?
Yeah, I think the zero fee trend, we're still kind of watching it play out right now, right? Particularly with Robinhood and the effects of the rest of the players reacting to Robinhood. I mean, like, what's crazy is, like, you look at the actual assets, and like people are really like responding to the threat of Robinhood that they are responding to Robinhood itself, right? Like, you look at, particularly with some of the big players, like what basically, like, I mean, I view it, it's more, it feels like an Amazon like strategy to get market share from a startup perspective. But then you do have these major brokerages now kind of responding, and by really two things, right? Two activities. One, focusing on what they're good at, and then building their business model and pricing models around their differentiators. And then secondly, really taking their head start in their war chest and starting to consolidate and buy out where they can, market share where they can buy it, right? Like, that's really been a lot of what you've been seeing in that side of the space in the past 6 to 9 months. But at the end of the day, I think right now, that particular story is actually net benefit for the consumer, in my opinion, because it does lead to more value and more compressed fees structures for the consumer. I will say, though, that that particular Robinhood story probably affects the broker-dealer layers than it does the advisors, because a lot of it's reallocating the value chain. And it hasn't quite hit the advisors yet. It's really more, I think there are some ripple effects, but people are kind of like seeing how that goes. I think that pricing, I don't necessarily think zero fee. I mean, it's really tough to do business on zero fee. Not every business can do it. But then if you think about like the advisory model, the fact that we have robo-advisors coming in between 25 to 50 basis points, in some cases bypassing fund layer fees, compared to your traditional offering where it could be anywhere between 2% for a fund plus 1% advisory fee on top of that. In the impact side, sustainability side, historically, you have funds that used to charge 2% plus a 4% front-loaded mutual fund fee. So we've come a long way, and I don't think the answer is still fee for everybody, but it's a more reasonable pricing for the consumer.
Yeah, I think that's a good point. And even in the case, obviously Robinhood didn't get acquired, but they sort of did change the industry. We have a little bit of time left. I kind of want to go back to you, Rich, about just sort of changing regulations. And I think that especially from a consumer financial protection stance, the way the Bureau operates, it's a little bit of a sort of, politically entrenched organization. So how do you sort of see, the CFPB changing over the next, 5 to 10 years? And how do you think that other regulation outside of that will really affect financial tech companies as they try to as this industry and market really grows?
I think it's very difficult to predict the trajectory of the CFPB because it's still so situated that the political atmosphere can matter dramatically. Right now, we're facing a very binary choice in less than 2 months here that will tell us a lot about what direction this goes. But, the CFPB has been trying to work for years on lots of different fronts, educating consumers, simplifying disclosures so that consumers can better navigate the financial marketplace, enforcing the law in an even-handed way so that all players know that they're required to take on the burdens of complying with the law and leveling the playing field in that way. And also trying to develop regulations, sometimes where Congress said you have to, sometimes where it seems that there are problems in the market that call for it. Those have been both embraced and resisted depending on their particulars. Again, debt collection is up on the agenda for the Bureau for a new set of rules. I think a lot of people on both sides of the provider and consumer divide want to see that happen. It'll happen differently depending on who the next leader of the CFPB is for the next 4 years. But there's lots of other things that will vary enormously depending on the path that takes.
Yeah, and I think, Rich, I think that's a good point. And I almost wonder if, in the case that the CFPB or really just regulation in general kind of is a little bit more lax and a little bit more laissez-faire, if that creates more opportunity for financial tech companies. I think a perfect example of that is the CFP recently released rules that said that payday lenders don't have to check whether or not the loans they give out can be paid back by the individual.
It's a good point you raise, Jonathan, because it reflects the fact that there's an interconnected dynamic here. And as regulations change, that means the market changes. There's new opportunities in the market and new players rise to fill that opportunity. And then the regulations may change in turn, and there's going to be an ebb and flow of this for a long time to come. But it is certainly the case that the marketplace is by no means static, far from it. It moves pretty quickly in financial services because, again, the nature of these products is that they can be altered significantly very quickly. They're not like physical products. And therefore, we have to be alert. Both the regulators have to be alert to what's really happening in the marketplace and whether it's different today than it was yesterday. And innovators have to be alert to their opportunities, which may not last for a long time and need to be seized while they're available.
Yeah, I think that kind of exactly sums up that interplay between them because it is always complicated and it is always ebbing and flowing. We are almost out of time here. Anybody closing thoughts before we kind of wrap up?
So I have a question for Rich, mainly about regulation and fintechs, and really regulation catching up to those fintechs that aren't being in compliance with the laws right now. How do you see that going? Like, do you think that's going to be something we see really soon? Is regulation, the regulatory firms are going to come to these fintechs and say, hey, you guys need to shut down your businesses. You did this and this wrong, or you need to fix this and that.
Again, I find it hard to predict the immediate future for the CFPB, just given that the election looms over everything right now and the direction will be very different depending on the outcome that election. I will say that the states are starting to step in and be more muscular in looking out for their own consumers to the extent they can. And I think you're going to see more of that. I would say for me, the crystal ball right now is pretty murky.
Okay, thank you.
Jacob, go ahead.
If I can also ask Rich a question, I'd be curious, especially like, CFPB has a pretty big lawsuit against Lexington Law, who's supposed to be the most legit and fairest player.
Sorry, against whom?
Sorry, I'd be curious, especially in light of the lawsuit the CFPB has against Lexington Law or creditrepair.com, like who's supposed to be the most, rule-abiding of the bunch, where you see the credit repair industry going in terms of evolving or where it's going to end up in the next 10 years or so.
Again, I'd be hard-pressed to try to answer that question in any honest way that I thought was helpful. We will see. As to how law-abiding that company is, its purpose of conducting an investigation and to bring a lawsuit is to air those issues out and see. And I don't know where that lawsuit stands at this point. But I will say that in terms of what it is you're trying to do, which is open up the credit box a bit more transparently and widely to more Americans, it's a badly needed objective to be fulfilled. And we are getting various ways of going about it, including more and better data that can be used to assess consumers, whether that's adding utility bills and some of the rent obligations that people diligently pay but get no credit whatsoever for in terms of their own credit standing, or financial flow information from people's bank accounts, which can be very indicative of their creditworthiness. And you can really get that. I mean, when you think about the unbanked population, it is much smaller than the population that doesn't have access to credit. So that's another way to fill that in. There's lots of different innovations being probed and tried in this area. And my guess is it's such a crying need that we will make a lot of progress on it. And a lot of it will be done from the private sector in the coming years. And by the way, that's another point, is the CFPB and all public sector regulation of finance is essentially sort of negative in flavor. We can tell you when you're violating the law, and we can stop you from violating the law. We cannot tell you in any binding way how you should try to improve your products. You have to compete and figure out how to do that yourself. But certainly a lot of things that benefit consumers come from people finding a better way to do a product, all of which is legal. You can compete better and worse, all within the realm of acting legally. And if innovators are more effective at filling these niches, then consumers will be well served. And that's one of the reasons why we try to encourage the fintech sector for the most part.
Thank you. That was a great answer.
Yeah, I think that's huge. Merging fintech with regulation, like that should be the move going forward for fintech across the board.
Yeah, I just want to share a quick perspective, maybe on a particular issue. Sometimes I find it difficult to talk in broad strokes, but for sustainable investing in particular, there have been some recent activity on the regulatory front with the Department of Labor and some of the recommendations that we made recently. And I think especially if we have some investors on the line, some things to think about there is, one is to look at, let's say, other regimes as a data point for what the landscape could look like, particularly in Europe with MiFID II and how different countries are implementing those rules. It gives you a kind of a good lay of the land on kind of what the regulatory action could be, and then how it affects like products that are put out. I think for us also in the US, there are also different markets, sub-markets. Some are more highly regulated than others. So, for example, the Department of Labor rules will affect a body of capital that's more tightly regulated, particularly like your 401k money, ones that are more retirement-oriented. But there is kind of interplay there when we're out in the private sector side, where, one thing I'd be curious to see is, like depending on which way we go, whether there's that creates incentives for consumers to actually like start to move more money out of some of those vehicles into more ones that are actually more private sector driven in the fintech, for example, right? Like moving your 401k money into a self-directed rollover RIA account in order to access better sustainable investing or investing product as an example. So I think there's definitely that interplay there that I think we're all on the lookout for.
Yeah, and I think that one thing that is kind of difficulty of fintech is the number of different people that can sort of weigh in on regulation, for sure. There's a lot of different both government bodies and sort of quasi-private and quasi-public organizations that kind of weigh in. But that is all the time we have. I want to thank you all for being on this panel. It's been wonderful having you, and a special thanks to Rich Cordray for stopping by. Your perspective was invaluable, and we really appreciate the time. Thanks, everybody.
My pleasure. Thank you.
Thank you, everyone.
Thank you.